Imagine having two friends, Jake and Ali, who both need a loan for their businesses. Jake, a fan of tradition, goes for conventional banking, while Ali, a follower of Islamic principles, opts for Islamic banking. They're both entrepreneurs, both driven, and both in need of financial backing to bring their visions to life. Yet, though their goals align, the paths they take to secure their funds diverge significantly. While they both need the same thing, the way they get it is fundamentally different. Jake, being a user of conventional banking, approaches his bank for a loan. Like many others, Jake sees the bank as his go-to place for financial support. To get his loan, he fills out an application, providing his personal and financial details. The bank assesses his creditworthiness, determining his ability to repay. Once approved, Jake receives his loan, but it's not just a simple transaction. The bank charges interest on this loan, which is essentially the cost of borrowing money. This interest is the bank's primary source of profit. It's important to note that interest rates aren't fixed. They can fluctuate due to various economic factors, such as inflation or changes in the central bank's policy. This means that the amount Jake will have to repay can increase, adding a layer of uncertainty to his financial planning. So Jake gets his loan, but with the added burden of interest, which can increase over time. This is the reality of conventional banking. On the other hand, Ali, who uses Islamic banking, has a different experience. Instead of navigating the traditional loan process, Ali's journey through Islamic banking takes a unique path. The fundamental difference lies in the fact that Islamic banking does not involve interest. This is because it is based on the Islamic principle of riba, which prohibits the charging or paying of interest. So how does the bank make money, you might wonder? Well, the bank and Ali enter into a profit-sharing agreement. This is a principle known as mudarabah, where the bank provides the capital and Ali manages the business. Any profits made are shared between them in a pre-agreed ratio. This is known as equity participation, which requires a borrower to give the bank a share in their profits rather than paying interest. A fascinating paradigm shift, isn't it? Ali also gets his loan, but instead of paying interest, he agrees to share a portion of his business profits with the bank. Scene script. Both Jake and Ali get the money they need, but their experiences highlight the key differences between conventional and Islamic banking. Let's break it down. In conventional banking, Jake's loan is based on a fixed interest rate. This means that regardless of how his business performs, he's obliged to pay back the principal amount plus the agreed-upon interest. It's a system that prioritizes the lender, ensuring they receive a return on their investment, irrespective of the borrower's fortunes. On the other hand, Ali's loan from an Islamic bank operates on a profit-sharing model. Here, the bank shares in the risk and reward of Ali's venture. If his business flourishes, both parties enjoy the profits. If it struggles, both parties bear the loss. It's a system rooted in equity participation, fostering a sense of shared responsibility and mutual success. A significant distinction also lies in the guiding principles of each system. Conventional banking operates within the legal frameworks of the respective country. Islamic banking, however, adheres to the principles of Sharia law, which expressly forbids the charging or paying of interest, a concept known as riba. Instead, it promotes risk-sharing, fairness, and ethical investing. So, whether it's Jake's interest-based loan or Ali's profit-sharing agreement, the choice between conventional and Islamic banking depends on individual preference and beliefs. In the end, both Jake and Ali were able to support their businesses. Jake, through conventional banking, found a system that focused on interest and profit, a path that many tread. Ali, on the other hand, chose Islamic banking and discovered a system that aligns with his faith, one that avoids interest and focuses on shared profit and loss. Their journeys, though different, were both successful. They found systems that suited their individual needs, beliefs, and circumstances. It's a testament to the flexibility and diversity of the financial world. Conventional or Islamic, each banking system has its unique advantages. One may offer a straightforward path to profit, while the other ensures ethical and fair trade. They're just different sides of the same coin, the coin of economic growth and financial stability. Whether you choose to walk in Jake's shoes or Ali's, it's important to understand these differences when navigating your financial journey.